When you're getting a mortgage to buy a home, one of the most important factors affecting your interest rate is your credit score. So in this video, I'm going to cover what a credit score is, why it's so important, and also some big changes coming and that are really already taking place that are going to affect affordability when it comes to people's credit scores. I'm also going to share a few tips at the end to help you improve your credit score because, again, one of the most important things you can do to get lower interest rates. So this is the fourth video in the home buying series. Again, we have our home buying guide that lists all the steps in one PDF. It's kind of like an ebook. It's like, I think like 20 pages long. I gotta actually remember how many pages long that is. But anyway, if you want that resource, you can find that in the description, or you can feel free to tune in and subscribe and watch these videos, each one as they come out. Okay, so what is a credit score? Well, a credit score is a number between 300 and 850 that lenders and pretty much any credit institution uses to determine how likely they think you are to pay back a loan. Now, you may be the best person in the world to pay back loans. You may never miss a beat, but they have specific formulas that they use so that they boil everything down into a number, and using that number, they determine whether they think you're a good bet or not. So the way this works, and the reason it's important, is a lender hedges their bet by charging higher interest rates to people that they view as more risky. People who are really low risk get better rates. So if you're getting a loan and you want to buy a home, one of the most important things you can do is to increase your credit score, because the lender sees you as less risky, therefore you can get good rates. So how does this all work? Well, the credit score is built up of 5 different factors, and each one of those is weighed differently. So the first one is your payment history, and that makes up 35% of your total score. Payment history basically covers if you pay on time or not. The second part is the total amount owed, and that is 30%. The total amount owed is also called the utilization ratio, and it essentially means how much do you owe compared to what your credit limit is. The third piece is the length of your credit history. So that's 15%, and that has to do with how long you've had any given type of credit. The fourth factor is the types of credit. So how many different types of credit do you have? And that one's 10% of your total score. And the last factor is new credit. So have you taken on new kinds of credit, and does it have a really short history essentially? And that's another 10%. Now, again, this is not a comprehensive video on all the different factors involved in your score. It's just to give you an overview. And again, at the end of this video, I'm going to give you some tips to improve your score. If you want to learn more about a credit score, that's another topic, maybe another video for another time. So a lot of people wonder, what's a good score? Well, there's something called a FICO score, and that's, again, the score that we talked about. FICO basically breaks scores down into poor, fair, good, very good, and excellent. If you're buying a home, really, there's only one number that you care about, and that is 780. 780 is the credit score at which you get the best interest rates. Now, this is a big change that is happening in the industry. It used to be that if your score was 740, that you got the very best interest rates. Well, now they're changing things around, and now you have to have a score of 780 to get the best rates. And any score below that, in increments of 20, you get worse rates. If your score is too low, you may want to actually consider an FHA loan versus a conventional loan. Again, that's a topic for another time, and really that's a conversation that you'd have with your lender specifically about what loan type is best for you. One of the other things that's really important to know is your credit score also impacts your private mortgage insurance, which is the type of insurance you have to have on your loan if you have a down payment less than 20%. Again, the higher the score, the less you're going to have to pay in insurance. Okay, so we've talked about what the score is, why it's important, and now, most importantly, how do you improve your score? Well, there's a lot of different things that you can do, but there's 3 general principles to follow, and I'm going to share those right now. First is make sure you pay everything on time. In this day and age with automatic payments, there's really no justification for being late on a payment, although I actually personally just had a late payment because I thought I had an automatic payment and didn't. But, things happen. That happens every once in a while. It'll have a slight ding, but in general, you really need to make sure you're making all your payments on time, because that has really the biggest impact. The next thing you can do is lower your credit utilization ratio, which again is how much you owe compared to what your credit limit is. First and most straightforward way to do this is limit your debt. But one of the really easy things you can do is to continually request credit limit increases. So on a credit card, you can request a credit limit increase. So instead of having a $5,000 or $10,000 limit, you can increase that to $15,000 or $20,000. And as long as you're paying on time and they see that there's no reason for them to not grant you the increase, they typically will. And so if you're maintaining one balance and just making minimum payments, or just paying off so you're staying at a balance, then just by increasing your limit, you're reducing your credit utilization ratio. A rule of thumb is basically to stay below 30% or 1/3, somewhere in that range, and don't go above that. So if your credit limit is $10,000, try not to have a balance ever go above $3,000. The third tip I have, if you're looking at buying a home and want to get your score as good as you possibly can by the time you buy, the thing I'd recommend is to work with a lender. Good lenders have tools that they can use to help you get your credit completely optimized. So they can look at which cards you should pay off. They can look at all the different things that you can do to improve your score. So this is one of the most important things you can do. And if you're kind of in that place, you're like, well, we want to get our score up, we're looking at buying in the next several months, reach out to me and I'll connect you with a great lender who can help you with that. And I would say really, if you're within that 6 to 12 month time frame, now really is the time to start seriously considering these things. A lot of people wait until they're like a month or two out, and there's not a whole lot you can do in that time frame. So it really is important to, even if you're like a year out, start the process now, create a plan so that when that year comes around, you're ready and everything's in good shape. I have several new videos that are going to be coming out about this buying process, also about different market updates and aspects of Newberg and the surrounding area. So if that's something you're interested in, make sure you subscribe to the channel. Also, if you found this video helpful, please leave a comment and let me know what you found helpful. I love creating content that people actually find valuable and useful. So comments that you leave that show what you found helpful, I really appreciate. Well, thanks for tuning in, and I'll catch you in the next video.